In this video, we're going to look at purchasing of inventories, the sales of inventories, and sales returns of inventories. Obviously, this is a trading business. Here it says, Anugan Industries purchased goods from Croydon wholesalers for $770, which includes GST. Right, so that's important to remember. That 77 includes GST. So if we look at this and your train of thought should go, we've purchased goods. In other words, we've purchased inventories, which is an asset. We did not pay them. How do I know this? Because an invoice was issued to us. If the business paid, there would have been mentioned bought inventories paid by check, or we would have received a receipt from Cronda. So Cronda is now going to become a liability, accounts payable, and we also got to do GST. So that's how your train of thought should go. So let's look at this general journal entry. We will debit our asset inventories, right? Our asset increase on the debit side. Although we owe the GST, we will claim, because we're a business, we will claim the GST back. And I use the account GST receivable. Some textbooks might refer to it as GST credits receivable. So I know because I owe it or going to pay it, I will still as a business claim it back. So this is also an asset to me. We've created a liability, and the nature of liabilities is credit. We owe them the total amount, so my liabilities will increase with the total amount. And that is your general journal entry for that transaction. If we now go on to the next one, and we're going to look at the sales of inventories, and there we see the same business sold goods tax invoice. Tax invoice tells me that the person to whom we sold it, M. Jones, has not paid us. If they paid us, a cash register summary or cash slip or receipt would have been a source document here. It said we gave them an invoice. So we know we sold goods to M. Jones for $600. We still have to add the 10%, which means this amount is GST exclusive. So we got to calculate that. And then the second part is the inventories decrease with the cost price of $420. Right, so let's look at how we do it. And I'll break this up into steps. Step number one, I go and I say, I will debit my asset, accounts receivable. Why is M. Jones an asset? Because M. Jones owes the business money. M. Jones owes us the total, the sale price that we want, plus the 10% GST. And because this GST belongs to the Australian tax office or the tax office in whatever country you are, I only collect it, or the business only collects it, but it is payable to the tax office. So I use the account GST payable. In lots of cases, some businesses just use a GST clearing account, both where they then contribute the GST receivable and payable. Right? Some textbooks also refers to this as GST collected. Sales is a revenue. The nature of revenue is credit. And that's why I credit sales, I credit my liability, and I debit my asset, because all of them increased. Very important, part two or step two. The customer walks out of the shop. Just think of your supermarket. The sale took place, the customer walks out. In this case, he did not pay us, so bank is not involved. And that's the difference. If you had a cash transaction, pretend Jones paid us, then you would have debited bank, you would still credit GST payable, still credit your revenue sales, right? But in this transaction, it was a credit transaction. However, regardless if it was a cash or credit transaction, inventories, my asset, still decreases on the credit side. I create a new expense called cost of goods sold, which increases. So I debit cost of goods sold and I credit my asset inventories because it decreased. Right. if we go to the next slide and we look at sales returns or allowances. Now, very quickly, sales returns is normally when the customer brings the product back and we're going to put that product back on the shelf. Allowance, there might be something wrong with the product. It's not according to sample, and we could allow a discount to that. Right, if we look at this, now we've just sold stuff to M. Jones. We send them an adjustment note because he let us know something ain't right, and he returns the goods for 110, including GST. Now remember, when we originally sold this to the person, we said GST payable will be credited because that GST we owe to the tax office. We now give a discount or he returns a product. So we're not going to owe the GST to the tax office. What is the cost price of the product? $70. Why is this important? Because this affects my inventories. So let's look at the general journal entry. I create a new account, sales returns, which is an expense. I don't debit sales, the revenue account. I create this account and debit sales returns. Now remember, I say now the liability will decrease with that $10 because this time is GST inclusive. And how do you get the GST? You go 110 divided by 11 gives you the $10 GST. My liability decreases because I'm not going to pay the tax office that $10 anymore. My asset, accounts receivable M. Jones, also decreases. He doesn't owe us the full amount, right? He owes us this $110 less. So I decrease my asset with that. And now, as with sales, I go step 2. What happens to inventories? Inventories, my asset, I put the product back on the shelf if there's nothing wrong with it. Inventories, the asset increase, so I debit it. And then cost of goods sold, my expense decrease now, and I will credit the expense. And that is basically how you do purchases of inventories, sales of inventories, and sales returns.